Well, as we're recording this on the 27th of August 2019, the yield on 2-year government bonds in the United States is 1.55%, and the yield or the interest you'll earn on a 10-year bond or treasury is 1.51%. That's an inverted yield curve. The 10-year rate is below the 2-year rate and well below the Fed's policy rate of 2%. So does that mean a recession is on the way? We'll look at that today on the Debunking Economics podcast with Professor Steve Keen. I'm Phil Dobbie. So it is the normal case that an inverted yield curve leads eventually to a recession. It's all to do with the interest rates paid for bonds. So you buy a bond, you get a certain percentage back each year, and it fluctuates as bonds are traded for different prices on the secondary market after they've been issued. So if you buy the bond cheap, you'll get a better interest rate or yield. So when bonds are in demand, prices go up, the yields go down. And bonds are issued in varying lengths by the Treasury in the United States. They've got 1 year, 2 years, actually 6 months, 5 years, 10 years, even 30 years. And the longer the duration, the better the return you'd expect, because you're taking a bigger risk, because who knows what's going to happen in 30 years. So when short-term bond yields are higher, that means people expect something is going to be happening in the short term. They don't want to go and buy shares. They want to buy bonds because they're safe. So they push the price up. The yield goes down. The yield curve inverts. That is the theory. And every time the yield curve has inverted, a recession in the US has followed. Every time since the 1980s. 4 yield curve inversions, 4 recessions, and it's happening again, and it's sticking around for a little while. It certainly doesn't inspire confidence, does it, that speculators are so worried about where to put their money that they're going to put them in bonds where they're going to earn so little. And in some places, you actually have to pay to earn them. Bond yields are seriously into negative territory in places like France and Germany. So, Steve, does this all signal recession to you, or is it just that shares have got so high, people are worried that they're going to crash, and that doesn't necessarily mean a recession is going to follow? Or what do you reckon? Is in other words, is 2020 going to be 2008 all over again?
No, definitely not 2008 all over again. That's one thing I'm going to be emphatic about, because the basic cause of 2008, as you and I've discussed countless times, and central bankers have never discussed, was a collapse in credit-based demand that went, in America's case, from plus 15% of GDP in 2007 to minus 5% in 2010. And that was after America got to the highest level of private debt it's ever had in its capitalist history.
Right. So we don't have that problem now, apart from places. We don't have that now, apart from obviously places like Australia. Well, yeah,
we have a number of countries that are in the same. Like if you imagine what was happening back in 2008, one way I can make an analogy about it was somebody running up a hill towards a cliff. And you couldn't say when the cliff was going to hit in, because that depends upon different countries' economies. But in the case of Japan, for example, that cliff was hit at a level of about 200% of GDP of private debt. It finally peaked at 225. There's a difference between running up the hill and if you continue rising even as you approach the cliff. Falling off the cliff is where credit demand goes from positive to negative. And in America's case, that happened when private debt was about 160% of GDP. It then peaked at 170. Now, since then, it's fallen. The level of private debt's fallen to about 150%. It's reviving very slowly now as a percentage of GDP. But in a sense, once you've got pretty much the same level of debt, but about half the level of credit, in the sense that the rate of change of debt now, which I define as credit's about 7% of GDP. Back when the crisis hit, it was 15% of GDP. So going from plus 7 to minus, to say minus 5 is bad, but nothing like going from plus 15 to minus 5. And I don't think they're going to go to minus 5 anyway. So you don't have the same decline in credit-based demand that you had back in 2000.
So what's going to cause it this time then? Because everyone is in a very different position, aren't they? I mean, there's if you look at the United States, for example, they're carrying a lot of government debt. But you indicate many times that that's not really that important in the scheme of things. If you look at Germany, they've got no debt. They're trying to balance their books, and they're actually in bigger trouble than the United States is. Look, if we look in the UK, I mean, the Bank of England, are saying if it wasn't for Brexit, they'd actually be pushing rates up now. So if we are heading to a recession, and there's a whole myriad of different reasons, perhaps, as to why it's going to happen, but also different perceptions of whether it's going to hit their country or not.
Yeah, I mean, to me, there are three basic situations the global economy finds itself in. One is what I call, in Can We Avoid Another Financial Crisis, I call the walking dead of debt. And those are countries like America, Japan, the UK, Spain, which had already had debt crises back in 2007, and private debt was now falling. And those countries, they're carrying such a level of private debt that you can't encourage people to take out debt faster than GDP is growing. And in most of those countries, debt is slowly falling. But it means credit-based demand is quite anemic. And if central banks like the Fed did do in the last 2 years, federal banks who don't even take a look at the level of private debt, they completely ignore this particular indicator. Don't take a look at it. Their model tells them that with low unemployment, there's going to soon be high inflation. So they've got to put up interest rates to stop the high inflation happening. They put the rates up. Nothing actually happens. Inflation continues falling, which boggles their minds, but that's what's been happening. So what they actually do by putting up the rates is put pressure on people who are currently in debt, which means they're more likely to reduce their debt or go bankrupt. And it makes people who aren't in debt less likely to take out debt. So consequently, credit demand goes negative and you fall back into another credit-induced slump, but it's a small one. It's like the ones that Japan was going through after its bubble economy burst back in 1990. It never had a crash like 1990 again,
right?
But it had stagnation for the whole period. So that's part of the economy. Well, they see being in stagnation.
So that's one. Yeah.
Okay. That's the majority, not the majority, but a large part of the global economy, because you have, that's the United States, it's the UK, it's most of Europe, certainly Spain, Portugal,
Southern European countries,
not France, but substantial countries. And then there's countries which avoided the crisis back in 2008 by continuing to borrow. So Australia's the champion there, but so is Canada's in that list, so is South Korea. A range of other countries, even including places like Norway and Sweden, are in that situation. So they can have a debt collapse. They can have a private credit crunch. And I think Australia and Canada are certainly having that. So they're going to have it. And when you add them up, there's something like about 20% of the global economy that you could put in that bracket. That's substantial. But that also includes China. And that's another wild card, because China has such a level of government spending and no qualms about, balancing the books and all that sort of nonsense. So they've got the Silk Road project, they've got the infrastructure projects. That is counteracting the impact of the credit. The third class, that's like the three classes, so I better mention a fourth. The fourth is countries like Europe, which are imposing policies which they believe are prudent, but are actually stagnationist. We should have a good talk about this in a later podcast, because Germany's focus on not running a deficit at the government level and preferably running a surplus is one point that modern monetary theory is quite correct on. And that is that if you do that, the size of the government sector surplus is identical to the rest of the economy deficit. Now, if you're running a trade surplus, you can still balance that, because the trade surplus causes domestic money to be created to make up for the money that's being destroyed by the government or taken out of circulation by the government running a surplus. But with Germany's trades, by what I can tell, its trade surplus is rather anemic compared to past trends. The overall effect of everybody in the economy trying to save money, so households trying not to take out debt, and because Germany's household debt levels are quite low and not rising, the government trying to pay down debt, the trade surplus not making up sufficiently for those two actions, the economy is going to decline.
Right, and of course it is already, isn't it? In a place like Germany, for example, and possibly in the United States as well. Look, if you want to hear this full discussion, then you need to subscribe to the Debunking Economics podcast at debunkingeconomics.com, or become a supporter of Steve Keen on Patreon. Go to patreon.com/Prof. Steve Keen, and if you pledge support for his work in economics and changing the face of economics, Economics. It's a worthwhile cause. You'll get access to this if you pledge $10 or more each month. You'll get access to all the podcasts in this series. So hopefully you'll do that. Come back for the full version, and we'll catch you again for another edition of the Debunking Economics podcast with Professor Steve Keen. I'm Phil Dobbie. Thanks for listening.